Hello and welcome to the GSC Grays podcast. Today I'm with Managing Director Guy Coggrave as we discuss strategic planning for your family farming business post-budget. So Guy, the budget's impact on the farm community has been quite profound, with significant media coverage, especially after the protests in London a few weeks ago. But what are we actually seeing on farm? Who's approaching us and why?
So yeah, we're getting quite a number of phone calls and having a number of meetings now with clients that are seriously concerned about how the agricultural property relief removal or change in tax rate will impact on their business. I think the sort of clients that are coming forward that are most concerned are those that perhaps are the more elderly that haven't yet transferred assets down to the next generation, people in the late 70s, 80s and some in the 90s that feel like that they've got a very limited time now to look at these options and try and plan. But we're also having a number of meetings with people that are now starting to be proactively looking and forward planning how they might want to sort of drive the business forward and how these rules will impact on that and how do they start to look to adjust. And I suppose the final group of people that we're chatting to are those that have sort of transactional things happening that are driving forward decisions quicker and faster, that they're going to have to look at things. So, for example, people with development land that are maybe looking at a sale imminently were thinking that they would sell the land, roll over the money into more land, etc. So we're doing some work with those individuals as well.
Okay, so we break this down and look at maybe the inheritance tax first, because that is quite a big issue for a lot of people. What do people actually want to know and how are we responding to that issue?
So I think the first thing people are scared by the headlines. They're very aware from April 2026 that we will be looking at effectively an inheritance tax on death for those individuals that own assets. Instead of being at 100% relief, it's going to be at 50% relief. So effectively a 20% tax on assets over above £1 million per individual. So all of a sudden, something that was effectively not a concern, not a major consideration, because there was no tax to plan for. All of a sudden, there's quite a significant tax liability potentially there that will impact on the future of the businesses and the ownership of the assets.
So with the ownership of the assets, etc., moving forward, considering the 7-year potential exempt transfers, pets as their own, what guidance are we providing along those lines?
So obviously, this tax is effectively, some people are saying it's a tax by choice, so which isn't strictly true, and I'll explain that in a bit more detail. But where people have plenty of time to plan, they have the ability to transfer assets that will be subject to this charge to the next generation or to gift it to who they feel appropriate. And they have effectively, for that gift to be successful, they have to survive for 7 years, and that's deemed a potentially exempt transfer. Now, that's a very sensible way of managing the problem where, in certain circumstances where it's appropriate to do so. The challenge with pets is that you have to live the 7 years, and if you don't live the 7 years, the gift will fail, and then the tax will still arise. Now, there is a taper relief that affects that over the 7-year period. So after year 3, you start to see that 20% tax reduce down to 0 after 7 years and more. But the challenge with potentially exempt transfers for some clients is that once they've gifted an asset, they can't then benefit from that asset. So, for example, a farmhouse, if they wanted to gift the farmhouse, they couldn't then live in the farmhouse without paying a rent, otherwise they would be deemed to be receiving a benefit. So the potentially exempt transfer route is a really good route to go for some. For others, that just won't be practical or possible. So it's got to be looked at on its merits.
So for those farmers and landowners thinking about what they do now, what is the advice that we're going with?
So what we're saying to clients is we've got time to plan for most. For some, which we can talk about in more detail, timing is important. But these rules don't change until April 2026. And also at the moment, we've only really got the briefing notes from the Chancellor's statement. What we're waiting on is more detailed legislation that won't come out until the spring, summer next year. And during that period, there'll be consultations with various different bodies, and we might see this legislation change. So at the moment, our advice is not to make knee-jerk decisions and to react. What we're actually saying is to look at a three-phase approach for clients. So the first thing that we're advising all clients to do at the moment is to really sit down and think about what is their short, medium and long-term objectives and goals, irrelevant of tax, because I think our view is that the fundamental point here is that you plan what the business and the family's aims and objectives are first, understand that, and then look at the implications of tax. Because the one thing that will change is tax rules over many years. So we need to be really clear on how do we make the business perform, how do we make the business work, how do we achieve the goals that the family or the business owners want to achieve, and then take a step back and look at the tax implications. So the first stage is to look at the business and the strategy and the goals, and also the individuals within the business. So where does the business want to go and what do the individuals within the business want to achieve? The next stage of that sort of review process is to look at and understand exactly what assets are there, who owns those assets, and also start to look at some indicative values, because the first thing any accountant is going to want to do is look at the indicative values and then start to look at the tax implications from using those figures. So our advice at the moment is sort of go through this review stage, pull together all the information that's needed. Where's the business going? What's it going to look like? What requirements do the individuals have? What do they want? But also to look at sort of the sort of the values of the assets and also what's already in place. So I would be pulling out the partnership agreements. I'd be pulling out wills. I'll be pulling out all those sorts of documents, tenancy agreements, so that you've got the information you need for then to arrange a sort of a planning meeting with both your solicitor and accountant, and I would suggest your land agent or your farm business consultant. And our advice is to get everyone sat around the table. And that's when you move from that sort of planning to implementation stage.
So with the planning bit, is this something that farmers can be doing themselves before they bring in the accountants, solicitors and consultants? Because that sounds quite expensive.
Yes. So our advice is if clients are comfortable to do that, definitely it's something they should be doing themselves. If they feel it would be beneficial, I would say that's where the farm business consultant or the land agent could be a really useful facilitator to sit around the table, help those individuals facilitate a discussion between themselves, which sometimes is challenging and difficult, and sort of it's sometimes easier to have a third party asking those questions and facilitating those discussions. But also, I think from a valuation point of view, to get some indicative values, and we're not advocating at this stage sort of formal red book valuations or anything like that. We're meaning pulling together a spreadsheet of all the assets, and that's not just land, farm, buildings, farmhouses, etc. It's machinery, it's stock, it's all those assets that are owned, what pensions are held, what investments are there outside of it. That's all the information that's going to be needed. So the farm consultant, the land agent can really help facilitate that if the family feel they need that third party. And I think that will be the most cost-effective use of time and advice.
And so when you take that advice and then you implement it, it wants to be after the Finance Act has come out, looking towards 2026.
Well, slightly, yes and no. So I think what I would be encouraging is the next stage, once you've got that information, probably take most businesses to the new year to pull all that together and think, I think that would be a good time to arrange a meeting with the solicitors and accountants. And what I would be encouraging is everybody to sit around a table and have a discussion as a collective, rather than having separate meetings with the accountant, separate meetings with the solicitor, because what you'll find typically is that there'll be questions raised by the solicitor or questions raised by the accountant for each other. The farm consultant, the land agent probably can answer quite a number of those questions, but also it stops a lot of toing and froing in expense. So for efficiency and cost effectiveness, everyone sitting around the table, all the information available should lead to the best advice. And then a plan can be developed and worked up. And the reason why I think I would do that before the Finance Act is you'll be far better prepared to effectively then implement the legal agreements and everything else that may follow if you're restructuring, gifting assets or whatever it is you decide, updating shareholders agreements, etc. You'd be far better placed to be able to do that following that initial review, but we wouldn't implement that until after the Finance Act in case it needs tweaking to reflect whatever changes may come. But the broad principles and direction of travel hopefully have sort of been considered.
Okay, so that's good advice. And there's a lot of misconceptions, I think, within the industry about what's come out from the budget. What are the main misconceptions we're seeing?
So, good question. So I think the £1 million allowance, I think, is causing a little bit of confusion. So that's £1 million of assets after taking into account all liabilities. So it's if there's bank loans, if there's finance, for example, that would be offset against that value. So that's certainly one. I think the other is that the £1 million could be transferable between spouses, and that's not the case. It's £1 million per individual, which is a key point. And I've certainly heard a number of people already have started to change their wills to make sure that they have got ahead of that, even if they do an interim change in the will and then do this wider planning exercise that we referred to earlier, so that they can make sure that both members of the family or all members of the family have that £1 million allowance if anything happens to anyone. So wills might be something to look at in the more short term just to protect yourself. So that's one factor. And then it's been widely sort of reported in the press, I think, that a family of husband and wife would have this £3 million of allowance. And I think it is worth just breaking that down. So what that is that each individual will have their £1 million allowance, assuming that the assets are held in that way. So i.e. both parties own over £1 million worth of assets. So that's your 2 million. The further million is made up of the individual's inheritance tax allowance, the 325,000, which is then so between 650,000, and then provided the individuals don't own more than £2 million of assets, they have a main residence relief, and if they have a property which would then enable them to use an extra £175,000 allowance each, which takes them up to the £500,000 each, that's where the 3 million comes from. But it is quite complex. It's not just straightforward that a family farming family has £3 million worth of relief. So it's got to be looked at in the whole. And then the other thing just on that is worth pointing out that people aren't thinking about is the after 2027, pension funds will come into that £3 million as well.
Oh, will it? Right. Okay.
And I think a lot of people aren't necessarily considering their pension funds, but that will be another factor.
Okay, well, definitely something to consider going forward then. And we've had quite a lot of inquiries about trusts. Can you just quickly talk us through what a trust entails and any benefits that they may bring to a family farming business? Yeah,
so I think when people are thinking about whether they pass down assets to the next generation, there may be concerns. The next generation might not quite be old enough yet to inherit, or if they are old enough to inherit, is their pathway clear enough yet? Are they going to be involved in business long term? Are they settled? Have they got a wild husband or wife that is a concern? And that's where trusts can become a really useful vehicle. So trusts could be used as a sort of a mechanism to pass down assets into trust rather than to an individual to sort of protect the assets, but also to make sure that the beneficiaries, i.e. the children, for example, in this scenario, could benefit from the income from the trust and also from the capital from the trust. So there's nothing to prevent assets that have been put into trust to be appointed out to children at a later date. So it defers that requirement today to effective transfer. Now, a lot of clients, I think, are slightly concerned about trusts because they think they could be very expensive to administer. Will they lose control? And I think that's probably an unfair perception. Provided the trust is set up for the right reason, it is administered and used in the right way, they could be a very useful vehicle for people. The only thing I would say with trusts is if people are thinking about that, they do need to make sure that they transfer the assets into the trust before April 26, based on the sort of rules and regulations that we're expecting to come in, unless that changes, because there will be a 10% charge for assets going into trust after April 26, whereas assets that go into trust now, there won't be that charge. But we need to see the detail on that in the legislation. So that's probably what I would wait for until the summer of next year when the detail's known more. But trusts are an option that people should be looking at. So another factor with trusts is that we talked about the 10% charge on assets going in after April 26. If the individual that settled the trust doesn't live the 7 years for the potentially exempt transfer again, then there could be a further 10% charge on their death. So that is just another factor to be borne in mind.
I think it's interesting looking at the different options that family farms have going forward. And we've touched briefly on the gifting and the 7-year transfers. If we just go back to that, the failed gifts ideas, because I think that's something that we could go into with quite a bit of detail.
Yeah, we could. So I'll give a really good example. So I had a meeting with a client the other day, and we were chatting about their parents' estate, and the only asset that they had retained was quite a nice property in the village, probably worth nearly £1 million. So quite a nice property. And discussing it with them, they said that the property was already sorted because 9 years ago, the property was transferred to them and their 2 other siblings, which was obviously, hopefully, a good move at that time. But when we looked into it a bit further, I asked questions around the parents. Do they still live in the property? And they do. So I then asked a further question, as I hope that we've got a lease in place and that they're paying a market rent, which sadly they're not. So effectively, the reservation of benefit piece kicks in, i.e. that they've gifted the asset, but actually they've still reserved a benefit. There's a very strong chance, well, in my view, that gift will have failed. So effectively, what they thought was good planning, unfortunately, because of the reservation of benefit, would mean that that gift, if looked at the revenue, will have failed, and therefore it will fall back into their parents' estate. And therefore, when they die, it will be assessed for inheritance tax reasons.
And to overcome that, they pay a rent at market value.
If they pay a rent at market value and have a lease, and typically what we would do in that scenario is have an agent act for one side and the other, and it would be an open negotiation, so that there's that correspondence to show that that process had been gone through and that it was a current and fair market rent.
So do we think it's advisable, with all these changes considered, to wait in the hope that there may be a change in legislation or even government?
So I think it comes back to sort of our thoughts earlier. If you look at what are the short, medium and long-term goals for the business, that's good practice anyway. So to go through that sort of review process, have those discussions, then you're in a strong position to make decisions. And going back to my earlier point, it shouldn't be the tax that is driving this decision making. So I think sitting and waiting for a change in legislation or a change in tax probably isn't advisable. It's looking at what's the impact on the business, how does that work? And for some, the view will be that actually they need to move forward before the legislation comes out, because maybe timings of things that are happening in the business, it might be due to the age and health of individuals within the business. So the tax should not be the only driver on this. It's good business practice to be going through these discussions anyway and looking at the plan. And my advice to anyone is, if the tax rules were to change, if what you're looking to do you wouldn't do, then I would say you probably shouldn't be doing it anyway. So don't let the tax be the driver, but also at the same time, make good informed business planning and decisions.
No, good advice. And I think a query we've been receiving from a lot of clients is relating to land prices. Currently, it stands that as of April 2026, there will be a 20% inheritance tax on land and assets, etc. But do we think this is going to drive more land to the market and therefore affect potential land prices?
Okay, so it is a question we're getting asked very regularly. We've held quite a number of seminars recently, and it's been a regular question that's come up. So land prices are really driven by supply and demand. So the first thing to do is think about supply. So are we going to see a greater amount of supply of land coming to the market because of the changes? We were already starting to see a slight increase in land coming to the market because of the financial pressures that I think we're seeing within agriculture at the moment. Some of businesses are struggling from a cash flow perspective, profitability, and higher interest rates has driven some land to come to the market anyway. And also I think the changes with BPS and the agricultural transition has led to maybe more elderly farmers that have got to the point where actually is this still for them, and them looking to downsize, sell or whatever. So the changes in the rules certainly will see more land on inheritance tax. We'll certainly see more land come to the market. Why do I say that? some clients we've had conversations with already, when we look at the potential inheritance tax liability of 20% on death of one of the senior members of the family that might own significant assets, that in itself might be enough that makes the business not viable. Yes. And if the decision has already been started to be considered as to whether the business is viable now, that might be the factor that turns it to a positive decision that they need to sell or want to sell and reevaluate where they're going. So I think we will see an increase in supply. When we start looking at the demand side of things, I think there's still a lot of businesses out there that are wanting to grow and expand. There's still quite a lot of people with rollover money where there's tax advantages of spending that on a business asset, and land falls within that. And let's not forget, land will still be a really good inheritance tax tool for those that are trying to reduce the liability, because yes, there is a charge on it now, but it's still a 50% discount from cash in the bank or other things, and will be a valuable tool. So our view is that we will probably see land prices fluctuate more, and we'll see more variance across different locations, but we're not seeing or expecting a significant reduction in land values. We're also starting to see new buyers coming into the market, looking at natural capital and investment opportunities in that regard. So I think in the whole, I think land will probably hold. And if we're looking at a longer term view, I think it will continue to go up because there's a shortage of supply.
And finally, we've covered 7-year transfers, we've covered trusts, gifting, land prices. Is there anything else that you'd like to add?
I think my key message to everybody is that we need to start to plan and look at the business. Look at the business, understand those goals, understand what assets you have, what values are associated to it. Make sure the wills and partnership agreements and everything else are sort of current and available and reviewed, so that when you sit down with the solicitors and accountants, which I would be advocating we do, and let's be clear that there's not going to be enough advisors to give advice to everybody within the time frame that's available. So preparation, being organised, using your time wisely now to make informed choices in the summer would be where I would recommend everyone should be heading, unless there's a need to do something sooner.
Okay, thank you very much, Guy. It's been a very informative chat about a range of subjects, and this is something that is constantly evolving. So if you have any further questions, please feel free to pick up the phone to our team, and we'll keep you updated as much as we can.